And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning, welcome to the show. Of course, it is Thursday, second best day of the week. And yes, we are live today. And yes, we have audio today. We have audio today. So yes, unlike last Thursday where we had technical difficulties within the studio. Not today. It's all working fine this morning. That means Michael Lebowitz will be joining me this morning. We'll play a little bit of catch up from what happened last week, talk a little bit about the repo action going on, some other stuff. We got to get into all of that. The latest Fed announcement. We'll touch on all that this morning. Outside of that, markets did okay yesterday, rallied a little bit, which was good news. And a bit of that came on the back of, well, shall we say, not so good arguments put up by the Trump administration in front of the Supreme Court relative to their rationale behind using executive authority to issue tariffs. Now, again, as we've talked about previously, and this has always been our question, is that tariffs are a tax and taxes are a function of Congress. So, you know, this kind of case in front of the Supreme Court right now challenges the executive authority of the administration to be able to unilaterally just impose tariffs on our foreign trading partners as a tax, which should theoretically go through Congress. This is what the whole debate is about. Now, markets like that yesterday because, as we've seen during this earnings season, the most mentioned word during this entire earnings season has been tariffs and the impact of those tariffs on producers. Now, as we've said before, I got an email this morning from a listener saying, hey, you need to rethink your stance on tariffs because it's showing up in earnings. I was like, yes, that's exactly what we've been saying, is that consumers don't pay tariffs, producers pay tariffs. Those are the ones that pay the tariffs. Now, the question is whether or not they can pass those tariffs on to consumers, which we've stated that has not been able to be the case, which is why tariffs have not translated into big inflationary pressures across the board. So again, yes, tariffs have been impacting the profitability and earnings of companies because they're having to pay that initial tariff issue. So if there's a 15% tax on something, they're paying that. The question is, can they pass it on to consumers to protect their profit margins? So far in earnings season, profit margins have been good, but again, the most talked about issue in terms of the earnings announcements has been tariffs. So again, that's this potential now, and odds are dropping right now that after the arguments yesterday, the poly market odds for the Trump administration winning this case in the Supreme Court is dropping pretty quickly. So the question will be now if the Supreme Court shall rule on this by the end of the year, supposedly, and then the question becomes, can they go back to Congress and just pass the tariffs through Congress? Do they have other workarounds? I'm sure they're working on some other workaround for the tariffs right now. There's some other kind of very obscure language in the laws that say they can impose tariffs unilaterally for up to like 45 days. And so we'll see what happens here. But again, this is going to have a couple of impacts. One is the big question is what happens with all the tariff revenue you've already collected? You have to refund that back to the countries that you collected tariffs from. There's going to be a lot of moving parts to this, but the bottom line is that the markets like the news yesterday because, again, that will take away a tax that has been weighing on corporate profitability. So again, that's kind of what we'll see kind of going forward. But that's going to be the big topic between now and the end of the year is watching the Supreme Court case on tariffs. So with that, here's what you need to know before the bell this morning. Typical. And we've talked about this a lot, is that the buy the dippers continue to step in every time you get a retracement back to some level of support in the markets. And yesterday we came down, tested the 20-day moving average on Tuesday. Yesterday bounced off that 20-day moving average. So again, we continue to hold support right along this 20-day moving average. Tested the 50-day moving average, which have happened a couple of times, but it's been fairly rare that we get breaks below the 20-day moving average and head towards the 50. Those have been more aggressively bought. So as we continue to watch this market, it continues to just play out the same way, contained within a very defined channel right now. That channel continues to be in place since April. Not a lot of risk outside of that. And as long as, and really even with the markets kind of trending here, you should expect, as we said before, expect some pullbacks, particularly when markets get a little bit too deviated from that. And that's when we talk about, rebalancing risk, taking some profits, et cetera. But again, as long as we're holding these support levels, the 20 and the 50-day moving average, there's really not a lot to worry about. And for now, at least, the retail investor continues to step in, buy these dips fairly aggressively. And, as we're getting ready to head into year end, this should potentially continue to be the case for now, just kind of a choppy back and forth action with a slightly bullish trend into year end because of buybacks, because of earnings announcements, and because of basically just the overall momentum of the markets. We do have a bit of a momentum sell signal right now. So again, just, we could see a little bit of more sloppy trading here over the next few days. We are working off some of that relative strength overbought as well. That's a positive. But again, this market continues to be primarily a function of the fact that we're just trading a very small handful of stocks. We've talked about this previously, is that the breadth of the market continues to be somewhat of a concern. And this continues to be the kind of the factor that we watch, kind of the most here. This is a chart of the relative performance between the S&P 500 index and the equal weighted index. And just over the course, and we'll just take this back, let's just do a year-to-date comparison right now. This is a year-to-date comparison. The equal weighted S&P 500 index is up 7% for this year, give or take. The S&P market cap weighted index is up nearly 16% year-to-date. So you've got a 10-point spread, a 10 percentage point spread between the macro, kind of the mega cap S&P 500 and equal weighted index. This just goes to talk more about the breadth of this continued rally that we've had, is that it's been really focused on these mega cap stocks. So the top 7 continue to do very, very well. The bottom 493 are really just kind of struggling to get along right now. So again, just be aware that breadth issue remains. That hasn't changed here in a while. It's been a very defined market, but there is potential risk to that is worth paying attention to. So with that, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk about Fed, repo markets, Nvidia, all kinds of stuff. Got a lot of stuff to get into this morning. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. Of course, it is Thursday. That means Michael's joining me this morning. We got to play a little bit of catch up from last week as well. Again, as I stated, we had a little bit of technical issues last week. We weren't able to produce a Thursday show. So if you missed your Michael fix last week, he is back today. And good news is, cardiac-wise, he's doing fantastic. He had his cardiac test yesterday. Doctor said he's going to live for at least another 6 weeks. So all is good.
You're stuck with me 6 more Thursdays then.
Exactly. So, all right. Well, we do have a lot of stuff to catch up on, and we won't spend a lot of time on it because it's kind of old news now. But, was there any takeaway from the Fed meeting last week that surprised you, shocked you, anything we should be looking at in particular, outside of the fact that they cut rates and into QT, which is kind of what we expected?
I think, we expected them to end QT, but the speed at which they're doing it, December 1st, I kind of suspected it would be over a 2, 3, 4 month type schedule. So, that's the Fed's way of telling you, uh-oh, there's some liquidity stresses in the system. I'm not saying run for the exits, but they certainly recognize there are problems. And, I think as we'll be talking about over the next few weeks, months, we're probably a lot closer to QE in some form. It doesn't mean it's going to be traditional QE, but QE in some form to kind of resurrect liquidity into these markets.
Yeah, and that's kind of an interesting point, because that's also kind of the subject of this weekend's newsletters, just kind of going through the basics of what's happening in the repo market. There's been some stress in the repo market, which is the overnight repurchase agreement market. And there's been some concern there, and that probably fed into why the Fed kind of accelerated the end of QT. Like you said, you kind of expected them to slowly kind of end QT over maybe a course of a quarter, but not at the end of it. It's like, okay, end of the month, we're done. And again, that may go to this impact that we've got that's occurring. You've got this liquidity issue that's occurring within the markets already, and then slap on top of that the government shutdown, which is fueling that even more. Maybe the Fed's getting themselves into a point of concern. They don't want to wind up in 2019 again.
Right. And the other thing, if you notice, it seems like there's a little more two-way liquidity in the markets. You've noticed that gold and Bitcoin have performed poorly. And even within the stock market, there are 7 stocks going up, everything else is flatlining. So the most speculative markets that are very highly leveraged at this point, crypto in general, and gold, silver, precious metals, have been lagging. That's probably another sign. There are many reasons for it, but that's probably another sign that liquidity is weakening. We talked about it. Forgot what the driver was. Remember, some altcoins basically went to zero about a month ago. That was a liquidity problem. Didn't help that it was 5 PM on a Friday. But, there's a number of overnight markets where we can see that there are some days where there's a little stress in the markets, and the Fed's picking up on that. And I think they're probably hearing these echoes in the financial markets, and they're going to want to get in front of that. The last thing the Fed wants to do is see markets go down, right? That's not in their constitution. Their job is to support markets and make sure that speculation thrives. Right. So, tongue in cheek, but it's not that far from the truth.
Yeah, no, exactly. And look, the Fed has been adding liquidity to markets here lately, but one of the big drags right now is what's going on with the Treasury General account, which is the TGA account, and that's a function of what's happening with the government shutdown. That TGA account's been rising very sharply. It's up like $700 billion over the course of just the last few weeks here because of the government shutdown. There's a lot of money that's sitting there not getting paid out, and that money, as soon as this government shutdown ends, that money is, we're talking about stealth QE, that could actually act like a stealth QE, because all that money has got to get sent out once the government reopens. So all the government contracts get funded, all the back pay gets funded. That goes to bank accounts, which improves liquidity for the banks when that occurs.
Right, and that will happen. That'll provide a boost to reserves, and probably we'll see some of these liquidity stresses ease for a while. But then the market needs more liquidity, and it's so how long will the unwinding of the TGA account help? Is it 2 weeks? Is it 2 months? We don't know, but there's certainly a lot of data that's put out every day that will help us try to figure that out and report back to you on that, which we will. But it kind of leaves a more important question. Where is all this liquidity going? Is it going into productive investments? Is it going into crypto, into highly leveraged speculative investments? And that raises a lot of issues. The other, Lance, you kind of challenged me yesterday. We were talking on the phone, and the question is, why all of a sudden since 2008 is liquidity constantly a problem, and constantly a problem for the Fed to solve? And I'm going to take your challenge on that, and hopefully in the next week or two I'll have an article on that. But the short answer is a lot of it is regulatory. that the banks have been constrained in what they can do, how they can lend to others. So the Fed, to some degree, because the banks are constrained, has needed to kind of come in and be a bank for the markets. So I'll get into that in much more depth. It's more than just regulatory, but it's a very different dynamic since 2008 than before 2008. It's worth exploring.
Yeah, no, and look, I mean, it's there's a lot of things that are going on, and again, when we start looking at kind of the operation, this is why I'm just kind of going into repo a little bit in this weekend's newsletter, just really kind of explaining what it is, because this is one of the big arguments about QE previously, which was QE doesn't wind up in the financial markets. QE is just an operation between the banks, and that doesn't affect the financial markets. Yeah, it does, because when QE is done, you're increasing the reserves of banks, and banks loan those reserves to hedge funds, overnight money markets, all that type of stuff. Yes, it all winds up eventually in the financial markets. That's why there was a very high correlation, particularly initially back in 2010, 11, 12, 13, 14, very high correlation between expansion of the balance sheet and the financial markets. So there are impacts, and this is why it's important to understand the operations of going on, understanding repo, understanding what happens in that process, because it does impact the investment markets, because that money is getting lent through. Money markets use it for overnight transactions. Hedge funds use it for leverage. Banks use it through their proprietary trading desk. It does have an impact on the markets, and it's definitely worth paying attention to, and particularly when it comes to credit spreads and the credit markets.
Yeah, I mean, the repo markets are really, in some sense, the overnight repo markets are the markets that kind of hold the whole financial markets together. It's really at its core a big chunk of the overnight financing that allows banks to do what they do, hedge funds to do what they do, and ultimately it spirals out into the whole universe. And it seems like so few people understand what repo is, what reverse repo is, and where to follow those rates and what to track. So looking forward to your article, Lance.
Yeah. So again, I've got a bunch of charts and graphs and stuff this weekend in the newsletter. So if you're not subscribed to our newsletter, go by the website, realinvestmentadvice.com. You can also follow me on X and on Substack, both of those at Lance Roberts, and I post the newsletter there as well. So however you want to subscribe, you can subscribe directly at the website. We email it to you. If you subscribe on Substack, we email it to you as well. So pick your poison, but it'll be out this weekend. It'll also just be posted on the website as well. So kind of shifting gears a little bit, as we kind of get ready to start kind of winding up into year end here, and you kind of made this a mention before, is that the one issue about ending QT is that it now opens the door potentially for QE to return at some point. But again, we're going to need some type of potential event to cause that. And, there's going to have to be some type of financial stress in the market that the bank says, or the Federal Reserve says, we're worried about the impact of this. Particularly, their big focus has been really since 2010 has been this third mandate of consumer confidence. And in 2010, Ben Bernanke announced when they were starting QE2, well, the reason we're doing QE2, there was really nothing wrong with the economy or markets back in 2010. But he said that, they were worried about the economy slipping back into recession. We were just coming out of the financial crisis. They were worried about a return to recession. And he said, well, the reason we're doing QE is because we want to lift asset prices in order to boost consumer confidence, which will in turn generate economic growth. And since then, that's really been a big focus of the Fed, is inflating asset prices in order to keep that wealth effect in place. But, again, this is, if we get into a period where this AI bubble starts to come under pressure, or if there's some other, economic slowdown of consequence, they've now kind of put themselves in that position to very quickly return to QE to try to boost consumer confidence once again to keep the economy out of recession. Your thoughts?
All right. It's really a trap. They set themselves going back to 2008. In inflating assets in 2008, they never wanted to let them deflate and kind of get back to normal. So constantly, from 2008 on, they've been using their tools, and it's not just QE, but other tools as well, to help keep asset prices inflated. And if you look at a various number of valuation measures, they've been higher than normal. They're certainly very high today, but since 2008, they've been higher than normal, and they haven't really regressed back to normal nearly as often as they used to. So that's part of that is the Fed effect that they're having on markets, and part of it is the market has figured out that the Fed wants to keep asset prices inflated. So there's your buy the dip and the FOMO and all these cute sayings that we have, but they are reality. Yes, QE could start because of financial market issues, but could also start because those overnight rates we're talking about start spiking. And that's not page one news of the Wall Street Journal or Bloomberg, right? That's kind of hidden in the weeds. And that one may be a little bit trickier for some people to digest. Why are they doing QE? There's nothing going on. And that was the case in 2019. They started QE, they cut rates, I believe it was 3 times, because there was financing issues in the overnight financing markets. Hedge funds had to pay dearly to borrow money, and God forbid that should happen. So, whether it's page one of the Wall Street Journal or the back page, what causes a QE to start up, we don't know, but it's inevitable that it does start up probably sooner rather than later.
Right. Well, so this will be something we'll obviously be talking about as we get closer to that point. But the thing to watch right now is that there's certainly some stress in the repo market. There's certainly been a pickup in demand at the window, particularly for the overnight repo market. The important thing is that the lending rates are rising. And you and I talked about this back in 2019 when this was going on. We were here on the show kind of comparing this to and explaining what happens in overnight lending is that you're providing somebody guaranteed collateral and they're loaning you money literally overnight. That's the whole transaction. And tomorrow you've got to pay it off. And if you don't pay it off, they've got your treasuries, which are 100% guaranteed collateral for the banks. And the analogy you used back then was kind of imagine, you want to borrow $10,000 from your neighbor. So you put a fully paid for brand new Mercedes in their driveway, hand them the keys and said, I need to borrow $10,000 overnight, and here's my Mercedes, fully paid for, here's the title, I'll be back tomorrow, and you're asking for a 10% interest rate. That was where we were back then. And currently those rates are pushing up well over 4 now. You're about a full percentage point above the overnight lending rate by the Fed.
Yeah. And that's what makes this a little trickier, I think, for people to understand. This is collateralized. This isn't just a loan, an overnight loan. Fed funds is overnight loans that are not collateralized. What we're talking about when we're trying to figure out the stress is the collateralized markets and why they're trading above, like for instance, why is the SOFR rate trading above the Fed funds rate? SOFR is collateralized with U.S. Treasuries. That's the Mercedes sitting in a driveway, whereas Fed funds are just loans between banks overnight. Not that those aren't safe. Those are extremely safe as well. But it points to an unwillingness to lend money by some of the banks or an inability to lend money. And it's probably the inability because unwillingness tends to be more related to credit events. And there are a few kind of credit events that have occurred, but for the most part, I think this is a liquidity issue. And we're also going into year-end, Lance.
Right.
So the liquidity constraints, capital requirements tend to be a little bit more at year end and at quarter ends than they are on any given day. So that'll just exaggerate all these issues that are going on. So They may want to get in front of it before the end of the year. Right.
Yeah, no, it's going to be very interesting to watch. It'll be interesting to see how the market responds to this as well. And particularly in the credit markets also, which is kind of one of the things, kind of watching credit spreads closely here to see if there's any kind of concern starting to pop up, because that would certainly also kind of put, if we start seeing cracks in the credit market, the Fed will certainly start moving into a more aggressive stance in terms of trying to resolve the issue than just simply reducing, stopping QT right now. So we'll see. This will be very interesting. So Mike, let's talk a little bit about your article, because there's a bunch of comments in chat and right now about valuations and stocks, and one of our chat members, and I actually kind of saw this interview yesterday with Richard Bernstein talking about market froth and valuations, and valuations are certainly concerning. Capes running at 40 times earnings right now. Forward 5-year returns off current valuations are near zero historically. It's hard to believe because markets just kind of seem to be going up at a 20% clip every year. Everything is fantastic. Why not just throw money in the markets? But, at some point, valuations are like gravity, and valuations certainly matter. And, this is, kind of a concern we keep looking at is that, earnings growth is okay. We had 11% earnings growth in the third quarter. That's okay, but we're not cranking out 20 and 25% rates of earnings growth right now. I mean, you're running 40 times earnings with 11% earnings growth. That's okay, but that's going to get much harder to sustain that type of valuation over time.
Well, and the problem is a lot of that earnings growth is coming from 5 or 10 companies, 20 companies. It's not coming from the large majority of the S&P 500. And, that's what you showed that graph of the equal weight versus the S&P.
Right.
That's what it's telling you. The equal weight has been flat since July. The S&P keeps going higher. The NASDAQ goes higher than the S&P because they have higher weights of those 5 to 10 companies that are really the only companies with really great earnings growth.
Mm-hmm. Yeah, and again, there's a lot of speculation in the markets right now. You and I have certainly talked about that to a large degree, recently, and particularly when you look at more speculative assets, leveraged assets. We've talked about 5x leveraged ETFs. Everybody's just trying to gain leverage in the markets right now, and again, that's fine because markets are continuing to go up, they're continuing to rise, but if we start, kind of one of the interesting things to me is looking at forward expectations for returns. Deutsche Bank just came out this morning ratcheting up their earnings expectations to over $300 a share by 2026. That's a significant jump in earnings growth. And the interesting thing is they expect that not to come from the Mag 7. They expect that to come from the bottom 493, that there's going to be a big resurgence in earnings growth next year. And I find that interesting, Mike, because if you look back historically over the last few years in earnings, that bottom 493, their earnings growth has not been great. It's actually been very lackluster, yet the economy's been booming. We've had very, very strong rates of economic growth. And now they're expecting the Mag 7 to slow down in their earnings growth to about 8% annualized growth, but the bottom 493 are going to surge to 14, 15% earnings growth into next year and into 2020, well into the end of 2026. But economic growth isn't going to be at the same rate we saw previously. So, I'm trying to wrap my head around how do they think that they're going to generate this massive earnings growth on the bottom 493 without strong economic growth when you didn't do it when you had strong economic growth. It's kind of fascinating to me.
And with margins at pretty much all-time highs.
Right.
Are they? It's not. I mean, maybe it is. Can they expand margins even more? I don't know. I mean, you have a weak labor market, and if you expand margins, almost by default, some of that will involve either less pay or people being fired, which is not good for the consumer. It all kind of trickles down, right? A company may think it's doing a great job because they let go 10% of their workforce, but that's 10% that can't go buy as much stuff as they were buying before, which then trickles back up into the economy, which works into their sales and ultimately their earnings. Not directly, but it's a circular problem. So like you, I don't really understand how the bottom 490 or so are really going to boost earnings, especially with a consumer that's struggling. Now, if the economy starts going gangbusters and consumers are doing great, they're not worried about being fired or inflation or whatever it is that's been bothering them, they get over all their political issues that they have, maybe things change and the bottom 490 start doing much better. But it's hard to see what's going to change for the consumer to get them to really start spending again.
Yeah. But this is kind of the issue. I posted a couple of interesting charts this morning on AI in particular because we're starting to see, and talking about valuations, talking about earnings growth and these type of things, we're starting to see a massive pickup in the amount of debt that's being taken on by these big companies. In fact, the amount of investment grade debt that's been added this year absolutely dwarfs any other year going back to 2015. It's absolutely phenomenal, the amount of debt that's being piled on. And what's even more interesting is a lot of this debt is getting put in special purpose vehicles, SPVs, so that it's not actually on the balance sheet. So for instance, Meta did like a $20 billion SPV, so it doesn't show up on their balance sheet. So it looks like Meta doesn't have any debt, even though they have debt outside of their balance sheet. But we're seeing this big ramp up in debt to facilitate the expectations for AI, the build out of these data centers. There's a tremendous amount of this market that's riding on the expectation that all of these deals that are being done between Nvidia and Oracle and Nokia and Meta and everybody else is going to actually work out at some point in the future, and the revenues are going to be there.
Yeah, so prior to about 3 months ago, the industry was sort of self-financing itself. And we'll get into this with my article. But recently you've seen some big deals, Google and Meta coming to the market with huge deals to borrow money. And OpenAI apparently has been looking for government backing to borrow money. So the self-financing within the industry may be drying up. Nvidia seems to have plenty of cash flow, but some of these others that were all self-financing each other is drying up, and now they need to go to the capital markets, and that is not as, it's more rigorous, and it's costlier. So that changes the equation a little bit, but it also maybe tells you that the cash flows from some of these companies, or expected cash flows, may not be as much as they think they are, indirectly.
Right.
No, we can't lend you any more money because we're worried about this, that, or the other. We're not going to say anything publicly, but why don't you go to debt markets instead?
Well, and again, you're seeing that. Here's the graph that I posted this morning, which was showing that 2.9 trillion of global capex on data centers by 2028. But here's kind of the interesting commentary behind that chart, and this is from a guy on Twitter called Hedgie. He talks about, he says, Meta's hidden AI debt using SPVs. Meta's parked $30 billion in AI infrastructure debt off its balance sheet, which is kind of echoing a little bit of that Enron-style financing that we saw back in 1999. On the industry-wide leverage, Morgan Stanley expects $800 billion in off-balance sheet private credit deals by 2028. UBS warns AI debt is growing at about $100 billion a quarter. And so this is going to be kind of one of the new fields for private credit markets, where they're going to be the ones that are providing the debt for these companies through special purpose vehicles that don't necessarily. So Meta goes, hey, I've got a clean balance sheet, I've got no debt, but it's all sitting in these special purpose vehicles through private credit markets. So if something blows up, it doesn't necessarily impact Meta as much as all the private credit lenders that took on that risk.
And that's what Ford and GM do, for instance. Their debt is that they lend to consumers. That sits in a different company. It's their credit. Ford, like for instance, Ford Credit Company, or Ford Credit, whatever the name is different than Ford.
Right.
So Ford Credit can go bankrupt. Ford could be just fine if everyone, people stop paying back their car loans. And that, it sounds like they're doing something similar.
Right. No, it is. They're just getting it off their balance sheet so they don't have that impact. But again, this is, and the point is that this is a little bit reminiscent of what we saw back in the .com era, right? Just all this need to build out. I've got to get the money from somewhere. I've already burned through a lot of my cash flow to do it internally. And so now I turn to the debt market to finance that. And Deutsche Bank is talking about, or there was an article yesterday talking about Deutsche Bank trying to figure out a way to hedge some of that debt risk on their books that they've lent out. So again, I think there's going to be a real issue. But yeah, let's flip over to your article real quick, because it's kind of talking about this. This is Nvidia's infinite money loop. Is this a smart move or a red flag? The article is posted. We'll go through this, but the article is posted on the website now, realinvestmentadvice.com. So Mike, take it away. I've got your charts ready for you.
Okay, and really the purpose of the article was to go back and look at the late 90s and look at some of those deals that were self-financing of kind of the telecom infrastructure, fiber optic network. And what you stumble upon when you look into that is there's vendor financing and what's called round tripping. And they're both very similar. It's where the seller of a good is financing or investing in a company. Those funds are then used to buy the product. This happens all the time. Vendor financing happens in every industry, just about every industry. It's very common. Vendor financing is financing. So there's a difference. They're financing, they're providing a company money so that they can buy their goods. And when those goods are then sold by the company that's borrowing, the money's paid back. You can think of all the auto dealers around you. They borrow money to have cars on their lot. You think these guys can afford to have 500 cars on their lot to buy 500 cars and hope they sell them? They're financing them through the big automakers. Round tripping can be legal. It doesn't sound as legit, but it can be legal. But to me, I think the difference is that it's invested. It's not financing. So these are the type of deals we're seeing, like Nvidia and CoreWeave and Nvidia and OpenAI, where Nvidia is actually buying a piece of those companies. And in exchange, those companies are buying chips. But it's not one for one. It's not this direct relationship. So it all works. It's financing in a different way, but it can lead you to trouble. And we saw this in the late 90s. Lucent was doing these same kind of investment deals. Nortel went bankrupt. Lucent just about went bankrupt, but they got bought by a company called Alcatel. In both cases, their stocks went from basically a typical bubble pattern. They went from very high to very low, to pennies, dollars, and because the deals fell apart. And it doesn't help that they were deemed illegal. The SEC made them restate their earnings, pay fines, and that was pretty much an end to those companies. So, my article just looks at those two and just shows you what happened. And then, you kind of look at, Lance, if you want to show that
it's up.
Nvidia spider web.
Yep.
So that kind of leads you to where we are today. What's going on? And you can see this massive web of investments kind of all feeding Nvidia chip purchases. And Nvidia is, spending money too to help these companies spend the money. And one of the issues is let's look at OpenAI. What if OpenAI is not the real deal? What if there's financial fraud at OpenAI? What if, remember
real quick, we're not saying there is, just saying
no,
what if.
No, absolutely not. But, and I'm not even saying financial fraud. What if ChatGPT is not the leader? What if it's the AOL, right? What if it's the Yahoo still around? I still have a Yahoo address, but that's because I'm old, but no one else does. I'm not too old because the really old people have AOL addresses.
Exactly.
But anyway, what was that, DeepSeek from China?
Yep.
Right. What if there's a real DeepSeek or a better engine, and all of a sudden all that money and all those expected purchases of chips go away? What if someone creates a better chip than Nvidia? I know it sounds impossible today. So, Nvidia has hinged its hopes on a bunch of companies, as has Microsoft and Google and a lot of these companies. And they're all kind of in the same bed together. So it doesn't mean this won't work out fabulously well. But when we talk about that, all of a sudden they need to go to market, this spider web is not, it tells me the spider web is not able to provide the financing anymore that it needs. And, there's a risk that, is helpful to the market. Right, Nvidia is helping boost its sales by financing these companies, but at their same time, they're taking on counterparty risks that could not just hurt sales, but hurt their bottom line if they lose. So, I'm not calling this fraud by any stretch of the imagination. But it's also not vendor financing. It's that fine line between what are you doing to boost sales and what are the risks you're taking to do it.
Well, no, I think the key takeaway here is just to understand that if we're all piling into these companies, right? Nvidia and CoreWeave and everybody else, and we're looking at every company, and then again, this is very reminiscent to kind of what we saw during the .com buildup, which was any company who's related to .com, right? You bought the stock, and today it's like, oh, here's this company, they do this for data centers, and so let's run the stock price up, even though the revenues and those type of things don't really support it. So when we start looking at a lot of these companies that have had massive gains this year, the revenue growth isn't there. And again, the big risk, the whole point that you're trying to bring out is that there's a lot of this stuff, that's this kind of financial engineering that's going on right here to support the earnings growth and the expectation for earnings and keep these stocks growing, et cetera. These are all fine until the point that something doesn't work out. There was a really interesting chart out this morning. This was from Bloomberg Market Intelligence, and this is AI growth projections, and they're expecting that AI-driven sales by 2032, okay, so 2030, this is 2025, so 7 years from now, that AI-driven sales will be about, will grow from 93 billion to about 1.8 trillion. So huge growth in sales, this perfectly linear growth, trend of sales. This is the way projections always are. So we're all betting on that these things are going to come to fruition at some point in the future. However, there's a lot of things that can change. There's a lot of things that can happen. What if, and back in the late 90s, we saw graphs just like this for the future projections of Enron and other companies. It was just going to be massive .com revenue. And it did occur. It just didn't occur in the manner that everybody was projecting it to occur. And when a lot of the, expectations failed to meet reality, then that was where you had a major correction in the markets. And that's the big risk that we run here, is that it's not that maybe we don't get to 1.8 trillion in AI sales in the course of the next few years, but maybe it's 9 years from now, maybe it's 10 years from now, not 6 or 7. And all of a sudden, those valuations become very important.
Right. And, let's go back to 99. AOL was the leader. They're nowhere to be found. Microsoft was the largest stock in the market in the late 90s. Mm-hmm. And it was poised to do very well from the whole internet and everything going on, right? It did very well. It really killed it. Even before AI, it killed it. Its stock, it took 13 years for the stock to recover from 1999 to about 2013. So the point is, to your point is, will the revenue really support it? And will the revenue go to those companies in that spider web we showed, right? It could be other companies. It could be maybe Nvidia won't be the premier chip maker. Maybe OpenAI won't be the engine of choice. There's some, it can easily happen. So,
right.
This isn't a risk-free trade to buy AI and think that in 5 years it'll be great. And maybe it will be great in 5 years, but those stocks could have severe dips between now and then as well, like we saw with Microsoft.
So, all right. Any other thoughts you want to kind of talk about this morning here before we wrap things up?
No, but because we were off the air last week, I wrote an article. I just want to touch on one point on it. I went back and I looked at CAPE. And, if you think about CAPE, it does a really good job of projecting the future. And everyone just quotes the current CAPE. Like you said it earlier, we have a CAPE of 40. It's very expensive. Mm-hmm. Within that CAPE is Nvidia. And Nvidia is 8% of the market. So if you look at Nvidia's CAPE, it's roughly like 283. And if I told you someone had a CAPE of 283, you'd say that's the most expensive stock in the world.
Right.
But it's because their earnings from 10, 9, 8, 7, 6, 5, 4 years ago were minimal. They've ramped up in the last few years. So its PE is, in the 40s, 50s, much more reasonable. So if you just take out Nvidia out of CAPE, it drops CAPE by over 3. If you drop the Mag 7 out of CAPE, and that includes Apple and Tesla, which don't really matter for this purpose, it gets it down to 30, 31, something like that.
Oh, just there's 31.
Well, no, and that was my point. So there were a couple points now you're going to make me go into the whole article.
Yeah.
It's still high at 30. The stock market in 1929, I think, peaked at 27 or 28. And many other valuation methods that just use kind of trailing 12 months and current are also very high.
Yeah.
So I'm not saying but the point is that there is some real growth here. And if you look at PEG ratios, we talk about this all the time, those stocks, Nvidia, Microsoft, Google, they're not the ones with the massive peg ratios. It's unfortunately a lot of the other 493 stocks, many of which are just, boring staples and boring companies. So,
yep. Well, I posted
there's my thought of the day.
Yeah, no, I think it's good. It's a good point, too, because I've argued this previously. Like everybody was saying earlier this year, is like, oh, you got to buy international because they're cheaper than the U.S. stocks, right? U.S. stocks are so expensive, you've got to go buy international stocks. Here's a chart of U.S. forward PE versus trailing PE. This is just 1 year PE, so this is everybody. And currently, right now, the U.S. trades at about a 53% premium to the rest of the world, and that's. And you go, well, wow, that's, stocks are really expensive here in the U.S. Well, not really from that standpoint, because this is the implied long-term real earnings growth, which is about twice that of the rest of the world. And if you take a look at the OECD estimates for economic growth over the next year, the U.S. will grow at twice the rate as the rest of the world. So again, yeah, you're paying a higher premium for stocks in the U.S., because there is no growth really, or earnings growth in the rest of the world. It's all in the U.S. right now, and it's primarily in these Mag 7, as you just pointed out, with Nvidia growing their earnings, Microsoft, Meta. We just saw the earnings report from these companies. They're just absolutely killing it on revenue and earnings growth. That's why valuations trade higher here than the rest of the world, because this is where the earnings growth is. But it still doesn't. Right. I'm not saying they're not expensive. I'm just saying you're taking a big risk, on this idea where people say, oh, well, buy Europe because it's cheaper than the U.S. You got to be really careful of that, because there's no earnings growth over there.
And by the way, the dollar's sneaking back up again.
Yeah, back over 100.
Story for another day, but keep an eye on the dollar.
Yep. All right, that wraps up the show for the day. Mike, thanks so much. Be sure to go by the website, realinvestmentadvice.com. Follow me on X at Lance Roberts, on Substack at Lance Roberts. It's easy to find stuff. All our articles, Mike's articles, everything's posted there at the website, realinvestmentadvice.com. Be sure to like and subscribe to the channel. It certainly helps us very much. We do very much appreciate that. Like the show today. We need the likes. We need those little thumbs up. Helps us with the algorithms, gets the videos out there. So your help, most appreciated. Realinvestmentadvice.com. See you back here tomorrow.